Now we've learned about bootstrapping, friends and family. We're now going to kind of move up the chain of command into angel investors and venture capital. So we've got an assortment of all kinds of things. We've got venture capitalists, we've got entrepreneurs turned angels, we've got entrepreneurs, and we've got angels. So should be a good conversation. Jim Ellis is going to moderate the discussion. Jim is a classmate. Are you recognizing the team? We had a big parade of us. Great guy. He's been teaching here 6 years now?
Yeah, 6 years.
7 years. Did a search fund, bought a little tiny company called Road Rescue with Kevin Twill, his class in 92. Grew a thriving business called Assuring. And it's been a joy to work with Jim over the past few years. And we'll have him on as well. So thank you.
Thanks. So we're excited to get started today. That we've got a lot of ground to cover. I think the topic of both angels and venture capitalists is a broad and rich one. We'll only scratch the surface. We are fortunate, as Linda pointed out, to have a group of panelists who, as entrepreneurs and investors, have covered the spectrum, taking capital and supplying capital both as an angel and a venture investor. We'll get a little bit of their perspectives on how entrepreneurs should think about approaching capital sources, where you find them, what are the pros and cons of each of them, and how to prepare and protect yourself from making some of the common mistakes that happen out there in the market. So if we could, I'd like to start with asking each of you to describe a little bit about your background. Everybody here has had the opportunity to review your bios, but in particular emphasis on your experience in either receiving or supplying venture or angel financing. And I mean, I think you might have to start with you.
Sure. Can you hear me?
Just for reporting.
Okay. So my name is Amanda Reed. I'm a partner at Palomar Ventures. We're an early stage, primarily information technology investment fund. We have offices in Orange County, in Los Angeles, and up here in the Bay Area. We invest throughout the western states. We're currently investing our third fund, which is $225 million. And we invest anywhere from $2 to $4 or $5 million on an initial investment. So that makes us a little larger than the angel community. Sometimes we'll do seed investments where we're anticipating an A round close. We'll do maybe $250,000 or $500,000 to help somebody get out of their guest room with their card table and their Polycom and into facilities. I've seen some very interesting initial business setups. No garages yet. I'm hoping the next company I back will actually come out of a garage and I can get the commensurate return with that.
Move into my garage now.
We'll have to talk afterwards. If someone's got a garage that leads, there's Apple, Google. So my personal background is that I came right out of undergrad and did 4 or 5 startups in a row in Silicon Valley and elsewhere, and didn't go to business school. Something I regret for a couple of reasons. I get asked that all the time. My experience is I personally am on currently 5 boards, been on 6 or 7 at a time. I've followed angels, competed with angels, and so have certainly an experience in investing in very early stage, which is our sweet spot at Palomar. And happy to address from that context. I come at it from an operational background, from my own experience in startups. I came up through sales and marketing and then got kind of drafted into venture capital. It was not really my career goal, which is something else I get asked all the time. How do you become a VC? I was like, So, having been an entrepreneur and been a cultural hero and then becoming a VC, which is sort of more the cultural villain, I can say I enjoyed the cocktail parties more when I was an entrepreneur than I was when I was a VC.
Great, I'm Mark Cheung. I was class of '87, which I guess I keep on meeting people from the class of 2001 or 2004, so it's really depressing. I guess you could say I'm a serial entrepreneur. I've been in the internet for a long time. I've started and taken a couple of companies public. The first company I started, I did raise venture capital from the first day. The second company I started, we put it off as long as possible, and we raised our first round of venture. We raised $35 million at $90 million pre, because we had a dilution set in terms of how much we wanted to sell the company or not. So we waited and waited till we could get close to $100 million pre on the value. So we funded it out of credit cards, personal cash, and angels, but not from institutions. That company went public. It was called Snowball Convert to IGN Entertainment. Some of you may have heard of it. We took it public public markets crashed, we did a buyout, a management buyout to go private. And then we ended up selling it to Rupert Murdoch, and I went to Fox, where I ran all the internet assets, which were MySpace and American Idol and Fox Sports and television stations group. Unfortunately, Fox News, I don't know. I have something on tape, but I'm not sure I politically agree with the content, but you as a business person, you do what you do. So, but what I will say is I did compile some statistics that might be helpful from that period of time, because I know this panel is about angel versus venture, and together, side by side or otherwise. As an acquirer at IGN and at Fox, we acquired 18 companies between 1999 and 2006 in the internet space. And they varied from small startups with 4 employees to large companies with several hundred employees and several $100 million of revenue. All 18 companies, and I was just going through this morning, started with angel capital. 100% of them. All 18 were founded by either personal capital or angel capital. 5 of the companies raised venture capital out of the act. Now, again, this is a small sample, and I'm speaking from an acquirer standpoint. But 5 of the 18 raised venture capital at some point in time during their history. None of those 5 raised it at the seed stage. They all came in for growth capital at some point in time of growth in their history. The average exit price, which is the price we paid for the company, was more than 10 times higher for those companies that raised venture capital than those that didn't, in terms of what we had to pay. Now shouldn't be surprising given the fact that you have more capital, you have venture capital, you have growth capital, the company's going to grow, it's going to grow revenue, it's going to monetize, and then you're paying a multiple of revenue or multiple of earnings. But those entrepreneurs that did raise venture capital sold their companies for, it's actually closer to 12 or 13 times higher on the average. The only bad news is they got diluted. And I looked at some of the data from what I had, and this is an estimate, but the average founding team is a stake. And I found the founding stake as CEO or CEO and co-founders, if they founded the company together, ended up with about a quarter on average of their stake. So if the collective team owned 40% during the angel phase, they owned 10% at exit. But they got 12 times the price. So I can't tell you about the companies that went public that we didn't buy, the companies that we turned down because they wanted too high a price, the companies that raised venture and didn't do well. But I will say, and this is I guess good news, Brandon, that usually if you take venture and you know what you're doing, it's a good move. So I will go on the record to say that. Purely from a financial standpoint. So that's it. Those are the statistics.
Great, my name is Pete Flint. I am the co-founder and CEO of a real estate company called Trulia. We're a large online real estate company. And about 5 years ago, I was, so class of 2005, so 5 years ago, we were starting a business where I were at business school, and our office was somewhere between the CES and the Stanford Library. Our kind of fundraising over the years, we started with Angel. We thought we were kind of these very talented business school people, so we went straight first to Sequoia and Axel, and they said, very interesting to meet you guys. You're very clever, or you think you're very clever, but come back later. But we managed to raise, kind of after meeting dozens and dozens of angels, a good angel round, which is a convertible note. And then later on we managed to convince the people that said not right now to actually invest. So we got Axel to invest a little about 9 months after the first meeting, after they turned us down the first time. Then we got Sequoia to invest about 2 years after that. And in total we raised about $33 million. We raised the last round about a little over 18 months ago, before things went a bit sour. And that's it. That's kind of where we are.
Pardon, I'm Don Hutchison, and I'm supposed to be Bob's zip, but Bob couldn't make it, and so they found me out at the cafeteria. And I figured if I listened, I'd be able to, bullshit my way through the rest of it. No, I've got a long, just reputable career in business as an executive with various technology companies, and went full-time as an angel investor back in 2003. And since then have backed 29 companies. We've had about 13 outcomes, 5 good ones, 8 bad ones, and the rest are in place. Several of them are very promising, but invariably it seems to spend the time with the ones that are more struggling than not. It's all personal investment on my part, but I do co-invest with a number of people, and Bob would be one. And Bob is the head of a small fund in the city called Amicus Fund, and a great exemplar of somebody working with about, in that case, a $30 million fund and addressing exclusively the seed market. Work with a very large number of venture capitalists, sometimes at inception in the deals, probably most often later on in the activity itself.
We'll rotate first responders, if we will, so I'll move to you, Mark. Just give us a little bit of your perspective from sitting in the entrepreneur's chair, how you should decide which source of capital, particularly between angels and ventures, is appropriate for your ventures. What are the criteria you should look at? What set of circumstances would lead you one direction versus the other?
Well, I think I'm going to overgeneralize here, right? There's no set answers, but in generalizing, I would say the following: that angels tend to have and conduct less rigid due diligence. They don't need the company to be $1 billion to cover the return on the fund. Investing at $4 million pre and exiting at $80 million is a great return for an angel. A great return may not be the best return for Sequoia or Benchmark or Axel deploying hundreds of millions of dollars of capital. Right? Angels are comfortable doing total capital in $3 million into the deal, and that's it ever. Venture capitalists are going to want to get to that magical ownership, and they're going to push capital in for growth, and so they're looking for opportunities that use capital effectively, but need capital because that's the business that they're in for IRR. And so when I talk with, I do probably 3 angel investments a quarter, and when I talk to the investors, I'm the bad guy. I'm the angel who's asking them specific metrics and things, and I quite often end up finding myself telling the founder, if you want to go in the decliner, go ahead, but they're going to ask you the same questions. There's no free ride here. It's just that some of the angel investment groups that you see, they're coming in and they see 30 deals in a period of 3 days, and they're not doing as much due diligence, and they're investing more in the individual. Not so much the idea, but the individual and the passion linked between the individual and that passion. Do I believe in you, Jim, that you have the passion to do it, you have the experience, and I don't want to see 17 spreadsheets, right, or market sizes or cost of customer acquisition analysis or things that you might do. So I would say early, seed or early, where the company's strategy isn't totally baked yet, where you don't have evidence or proof of a customer deployment, whatever that may be defined. Product is still moving, the ideas are still moving, teams still being solved and formed. I think it's a lot easier to raise angels because I think you'll be much more successful statistically doing that. And I think when you have more of your act together and there's more maturity in the business and you're willing to be metric at that level, and you need capital for growth, which means your business needs capital, I think it's a great time to raise ventures.
You think both,
right? Yeah, so I guess this school of thought is, in many of the entrepreneurship classes is eat when dinner's being served. So when you can raise money and someone's willing to write a check, take it. We just, in the early stages for our business, we weren't getting any food at all from the VCs. They were very risk averse. What they looked for, particularly in the consumer internet space, was obviously this thing called product market fit. So obviously just traction within the business. They say great team, great product, great idea, but they're just not prepared to invest because they want to see some traction, some corporate metrics. So the angel route was the group that were pretty receptive to taking risk. They were if the team was good, or if the market was good, we found some pretty good success. I think statistically, it was just much easier to raise angel money. and broadly less of a time sink as well. The VCs were just a huge time sink for us.
I don't think it's virtually impossible to go from concept to venture funding. So whether you call it seed or angel, or it's your credit card, or your parents taking a second mortgage, I think in today's environment, and I'd say the environment that we've seen for several years, and that I suspect we'll continue to see for some time, you've got to have at least a modicum of traction behind the business before raising venture funds is a worthwhile pursuit. I think Pete puts it well. You spend an enormous amount of time. The thing that you've got to remember is that the VCs you're talking to get paid. You get paid well in some cases, depending upon how senior the VC is you're speaking with, to talk to people. There's very little pressure on their part to do anything. And if you're a venture investor, any investor, it's always better to know more about the investment than less. And so they've actually got an incentive to take more time, see how you do, see how things develop. You probably experienced some of this before they commit. And it's a tremendous amount of energy on your part. So I'd say realistically, you've got to have some sort of plan for how do I get, whatever it is, that first 50, that first 100, the first 500, whatever you're going to take to achieve some sort of early stage traction, whether it's the prototype of the product, the first sale, or the like. So I don't think it's so much an either or. I think it's really an issue much more to do with timing.
So I've been sitting here debating whether I should encourage you to go to all the venture funds so that my colleagues who ever see this tape would say that you sent them all to the angels. So let me just sort of build on something that Don said. So it's certainly a truism in this economy that the venture business is in turmoil, that there are a number of funds that are not raising new funds. There are some big names that are in the business for the long haul. There are some well-known names that are working through what sectors they invest in. That makes it a difficult environment to know whether you're pitching the right VCs. So I would certainly say that there are VCs, we've done deals where we know the founders, we know the entrepreneurs, or we are introduced to them through a reliable source, and we just like the market that they're doing. And we certainly want to scoop the angels in some of these experiences when we can. At the same time, there are a lot of people taking meetings, to Don's point, who are paid very much associates in a lot of these bigger firms, certainly partners, where I'll get pitched 2, 3, 4 times a week. And I very frequently will give feedback saying, go see if you can find some angel investing. There's also an aspect of terms around this. People tend to treat venture money like it's getting into a good school, and maybe it's the most recent experience that someone has. And I'm often replying with, are you sure you understand what you're doing here? People tend to say, I got money from so-and-so. It's like, no, you sold a controlling interest in your business to so-and-so for X amount of money. Let's make sure we've got this straight. This wasn't, there are terms in the venture business that were outlawed in biblical times, and there's an aspect of the financing where the earliest money you take is the most expensive money you take in terms of how much you give up for it. And while we generally see angels in the deals that we back, what we're hoping for is that they're good angels, that they've done straight up terms that are easy to work with, that they haven't put anything in onerous, they haven't gotten too cute with their financial models in terms of putting discounts on the conversions, and there's all sorts of things that can go wrong in an angel round that can make it difficult for you to get venture money. So I guess I'd net my comments out in a few ways, which is raise money from your friends, your families, your credit cards, from the least dilutive sources you can first. Make sure you understand the stratification in the venture business so that if you're going to pitch VCs early, you're pitching true early stage investors. The turmoil that's going on right now is having sort of a barbell effect in the venture market, where you're seeing a whole new creation of venture funds that are sort of like super angel funds. Yes. And they're investing in the same range as angels with the belief that if a company needs more than $3 to $5 million, that it's just doomed to get them any kind of exit in this kind of market anyway. So there's a whole new class of venture funds that I would call micro-investing in terms of typical venture strategies. And then there are these heavily diversified international funds that do early stage and do LBOs. So spend some time to know, before you spin your wheels, whether or not you're talking to a VC that really is in the space, because you can just spend hours, weeks, months, years educating the VCs at your own expense. Right? So make sure you understand that. That being said, I think that the angels, particularly in the past 3 or 4 years, play a crucial role in helping fund and filter good companies that the VCs are then more than happy to see at a later stage. So I wouldn't say don't pitch the VCs because it's going to be a waste of time. I say do pitch some VCs, listen carefully to the feedback, make sure you're making a good use of your time on who you're pitching. We're true early stage investors. Sometimes I compete with angels. Usually in this market, I end up following them.
So maybe you raise a good point about entrepreneurs being smart about which venture capital firm they approach. Maybe just because we're in order, starting with you, Pete, would you give us your perspective, each of you give us your perspective on, regardless of which category of financier you're talking about, what criteria should you use or what should you look for in a particular investor or a particular source of capital?
So just thinking through, we raised the angel or the seed round from I think maybe about a dozen individual investors. How we found those guys that ended up investing, I think there were, one was just friend of a friend of a friend. That kind of like use your personal networks, obviously. Probably the second most important criteria was a history or personal interest in the product. So I think just speaking to lawyers who'd worked on similar fundraising for not so much competitors, but companies within the same space, we said, well, who invests in your company? They obviously understand the space. They can add some value because they have some perspectives of watching that company grow. And so to get money from those guys was so much easier. And I think probably 75% of the angels had invested in similar businesses, either similar from a vertical perspective or solving similar problems, or on a horizontal perspective. So connections and passion about the product or industry.
And how about a venture from your perspective? Because you went from angels to venture. When you approached, did you start with the Harvard and Stanford of venture firms, or how did you think about it?
So our, I think our belief was, in the venture industry, there's huge amounts of options to take money from. Much like business school, you start at the very top and see if you can get money from those guys. I think I think the reason we took the money from those guys was partly brand, because we thought, we can get money from a lot of people, but having branded money helps significantly with recruiting. So trying to hire the right people. There were a bunch of people in our company that just said, well, if you're backed by this particular company, or this particular angel, then I want to join your company because it looks like a free screen. But probably most importantly, it's about the people. It's about the partner. If you're going to call this person on Sunday night because you need help in a particular problem, or if you're going to be in the trenches with our investors for the next 5 years, as it turned out with these guys, you've got to feel that strong rapport that they're going to do the right thing by you. You're going to do the right thing by them, and they can be good battle buddy for you guys as you scale the business.
On the startup side, the angel and seed and so on, I think the referral from lawyers, that's an excellent thought. You also get a fair number of referrals from talking to VCs. So to Amanda's point, very often, even if you're early on, they can be a productive source of referrals to angel and seed investors. And then, of course, networking. I think the characteristics I look for in the seed investor is somebody who, A, can afford to lose the money, and so isn't going to, burden you with undue questions and inquiries because they're concerned about the loss of capital associated with the investment. And that can be difficult if it's coming from friends and family, but sometimes you make those compromises. Secondly, if they can help you, if they have actual experience in category, passion coupled with actual experience in a relevant space to be helpful. And thirdly, if they can help you with the next piece of the journey in terms of introducing you in a favorable fashion to downstream investors. Yeah, as with so many things in life when it comes to finances, when you most need the money is when you're probably least attractive, and it's the most difficult to get. And so what I found in our own experiences is that companies that we struggled mightily to put together that original $500K, that first $1 million. When we were doing well, you know, you had 7, 8 guys looking to give money to you, a great deal of money on wonderful terms. So it does get easier, you know, as your momentum builds. But I would find that typically that early dough is probably the most challenging to come by, yeah, assuming you have success. Then we have other kinds of deals that are much more difficult because we haven't had it.
I think the other thing I'd add is when you're out raising angel money or when you're giving stock in your company to people who are helping you as advisors, if I had my druthers, I'd like to see as few names on your shareholder list as possible. And I'd like to make sure they were all accredited. And I think, you know, maybe this is an obvious statement, but when people raise money from friends and family, and sometimes they take monies from their neighbors, and you can end up with a list, and later on in life when you're investing as a VC and you're trying to get approval for something or you're trying to get notice out on something and you've got a cast of thousands on an angel list and you've got to go through it. Numerous times I've had to go through and buy people out because they've taken money from someone who's not accredited, creates a financing issue down the road, or there's just a ton of them. You know, and I've asked someone for, you know, so who'd you give stock to? And, you know, and the list comes out like this, and it can be kind of a headache. So certainly if you can get concentrated chunks of money from people, I think Pete made an excellent point in the beginning, the best place to go get money is from somebody who knows a lot about what you're doing, right? I mean, the value that comes with money is highest in the beginning stages of your company when the advisory connections, the reason these big funds have good brands is because the partners, I think, are generally value add. The later in your financing, the closer you can get to dumb money. The biggest mistake I think you can get is get a lot of dumb money early on and have it and from a variety of sources that are going to cause you a headache later. So aspire to quality as early as possible and try to keep it in concentrated blocks if you can.
So, sorry, just before we leave that, on the venture side, you talked about the importance of approaching the right firms. How do you figure out what firm is the right firm for you to approach?
You know, I wish there were directories. There's word of mouth. There are various online sources of different repute, some of which I love, some of which I roll my eyes at. I was like, oh, come on, you know. I mean, unmoderated forums. You can think of them, I suppose, that rate the VCs. You know, I wish I had a better answer for that. And I'm assuming that somewhere in the business school there are resources, I'm hoping. I would go through word of mouth and ask people. One of the biggest points I wanted to make when you're pitching is, you know, you're going to talk to some people who you think have nothing really to tell you. And I've gotten into numerous arguments with entrepreneurs about their market or their timing. And I think try to get something out of every conversation that you can use. And one of them is say, well, I know this isn't interesting to you, but who else do you think, you know, might be interested in this? Or what size of firm do you think I should pitch? I always want to leave a conversation feeling like I've added value to an entrepreneur. And I'm always aware of the sort of the Colonel Sanders and the Walt Disney stories about having pitched, you know, 200 people before they got funded. So I'm always trying to make sure that even if I don't like this idea or I don't think this is the right time, that they're going to look back fondly on the conversation and bring me their next great deal. To that end, I'm more than happy to sort of provide a list of those things and other resources if I feel like the person's genuinely listening. Sometimes I get pitched and it's like, okay, as soon as they realize I'm not going to fund them, I can see the mental doors close, right? And they're just kind of on to this was a waste of time kind of a thing. So I'd say really penetrate through this kind of typical language around why someone passes. It's too early. You need proof points, which are sort of veneers that people can put out to make a pass easy. And really genuinely ask, you know, what tips have you got for me, not only in the business strategy, but who else should I be talking to? And I think that's how you sort of virally network your way through. You know, if I had a ready directory to tell you who these, there's Baseline, there's First Round Capital, there's some of the super angel groups. Somebody's got to have a compilation of this somewhere, and, you know, I have it in my head. I just don't blog about it, I guess.
They're almost unrelated topics in my mind, angel versus venture in terms of your screening and process and decisions you go through. I think on the angel side, you have to consider a couple of things. More often than not, you're determining the term sheet, right? There's no lead investor who's participating preferred and all these. You're saying, you know, I'm raising $1 million. Can I get 50, 100, or 150,000 from you? That individual does other things for a living. They give you 100. They may never invest in your company again. You may not even care. they invest. You don't probably care whether you have 6 investors or 12. You want to fill the round out. You might even get away with a convertible note that will convert when you do raise venture. And so the process moves pretty fast if you develop momentum, and you're in control more often than not as the founder or the CEO. So that being said, I would try to avoid making certain mistakes. Jim, you and I spoke about this in one of your classes, which is I don't like raising money from friends because I think the downside is orders of magnitude worse than the upside. You know, the upside is you made them some money. The downside is you lose a friendship for life. And people will say, okay, you lost my money. Those blue sky laws. I understand. I didn't need the money. I backed you. But then, you know, then they don't come to your holiday party. And then you ask them, hey, you want to go to the Giants game? And they don't return your voicemail. And, you know, it just could get worse. So I just say, you know, they're like keying your car. They're keying your car in downtown Palo Alto. And you just, like, why would you want this in your life? There's so many other people you can take money from, right? Now, so there's, there you go. You got that on the record, right? So there you go. So 2 things. One, I would resist all temptation to bring money in from friends or family, especially your mother or father. But, okay. The loan is okay if you're going to pay her back, but just don't take the cash for her. On the other extreme, you know, there's a temptation to say, I'm going to go get these industry executives because they're all like lifelines and who wants to be a millionaire. They're going to be people who build companies, who know a lot about my sector, and the fact is, it'll be, I'll call you, you won't call me, you're busy, and you'll be able to help me, and it's going to look good on my deal. It's like, wow, you know, I went to Stanford or Harvard, wow, I've got this person in my deal. You know, that can backfire on you, because if your deal doesn't go well, I'm a person that, as an entrepreneur, I would say, you want to plan for the downside and have the upside come in. So you want to, when things are going well on the angel or venture front, who cares? You don't need anything. You don't need anyone. You probably don't even need capital. But when things go poorly, you find out who your friends are. And the risk is when you bring in these highfalutin individuals, that if they're not engaged in your deal, and they determine, I don't know about this deal, or, excuse me, Jenny, but yeah, I don't know if she did a good job, or I don't know, I haven't spoken to her in 6 months. Guess who Sequoia, Benchmark, Axel, Kleiner, Mayfield, Menlo, guess who they call? They call us all day long. Hey, Mark, I heard you put $100,000 in that deal. What's going on? If I say, you know what, I thought it had promised, but you know, it probably will never be more than 50 million. Bad news for you, because that's the due diligence they're doing. They're doing due diligence on the angels. You think they're your friends, but I get calls, I can't even handle them all day long from the venture investors saying, what do you think about deal X? They're asking for free advice. And if I put my money in the deal, they really want to know what's going on. I don't have enough in there to protect you, because I don't really care about the amount that I put in there. So I'm going to be dead honest, and I can write it off. And so it could go 2 ways. The person can really help you in the industry and have contacts, but you have to pay extra special attention to those individuals so that they don't have a negative opinion of you when you raise capital. Likewise, let's flip to the venture side. You know, on the venture side, there's a control issue here, right? It's going to be concentrated even in the syndication. And what you need to plan for is what happens after you get married, right? Are you going to continue to support me when the money runs out? Because it's a death knell if they say, you know what, we're not going to do the second round. We did preferred A, but you know, go ahead, go to the Valley and talk to everyone else. But pick your firm. But you know, we're out. Well, you know, we just decided we're out. You don't want to be there, right? And so, what can help increase your chances of that? Well, a couple of things. First of all, who is the partner that you take capital from? It might be a great person, but if they don't have clout in that firm, even if they love your deal, in that Monday morning partnership meeting, if 7 partners say, I think we get out of this deal, that person isn't going to stand up and say, I don't think so. I run this firm. We are going to double down. Even if they're not going to. They're going to say, you're right, I made a mistake. And that doesn't help you. So you need to think about the tenure and the position, the political power that the individual has that you choose to be the partner on your deal. I do think there is some credence to the fact that those venture firms in the Valley and in the East Coast that have more experience, for example, I'm in the internet field, can help you more in the internet field. It's not rocket science, right? They can put deals together. I don't think it's coincidence that YouTube and AdMob get sold to Google. It's just not coincidence for Sequoia, right? So there is value. We could argue and debate how much that value is, but those organizations have invested in your endemic sector. They understand how these businesses are run. There's no issue that you can bring up. Let's talk about that. Ad operations, class 1 or class 2 performance or display sales, content management system, a video player, a CDN, source code, or there's nothing that they haven't seen. So they're, I think, better off in terms of being able to help you with operational strategic advice, only because they've done it 50 times, including 30 deals that failed. That's all. And so I just think that it's a personal issue here, personal preference. If I were in a sector, whatever it is, clean tech, healthcare, internet, consumer, retail, I would seek a partnership where they had deep endemic experience in that field, right? And they're gonna be harder on you. Their expectations will be higher of you. But I just think intrinsically they have an unfair competitive advantage over many of their other competitors in the sense that they have industry experience and they've just been there before. So.
So a thread running through all those comments relates to the value added that your investors can provide to the entrepreneur. Don, maybe starting with you, what degree of assistance should you expect? What form should you anticipate that value added would take from an investor? And how do you determine that in advance? How are you able to assess claims of value added a priori?
So, two good questions. Taking the second one first, I'd say the easiest way to diligence any investor is to look at their prior experience. And within that, as they diligence you, a prudent entrepreneur should also diligence the investor and speak to those CEOs of the founders that partner has worked with. And try and speak as candidly as possible. And as with any sort of reference process, ask for people that they didn't give you. So I'm talking to Gail and say, gee, how did Amanda perform for you? And who else do you know that's worked with Amanda? And I want to find names that I didn't get, from that. And I'm not picking on Amanda, it could be any of us.
Fearless in the reference check.
But I think that's the common sense thing to do. Talk to other people that they've worked with, and see if those comments are the same roughly as what they've said to you. As far as what you should expect, that's a good question. I would say on the angel side, you should be fairly specific in the conversation as to what each side is bringing to the table. I think for many of the investors, they're bringing money. And it doesn't quite stop there perhaps for many of them. They'll bring a Rolodex. But if I'm Ron Conway and I'm in 100 deals, I'm not sitting there sweating with you on your marketing plan. I may let the Rolodex work for you, on specific requests, but I've got a lot going on. If I'm somebody who takes a passionate interest in a handful of companies, and I'm going to be, your board member, I'm going to be a virtual co-founder of the company, that may be good or bad, depending upon what the company needs and what that person brings to the table, but be clear, about what the overlapping roles and expectations would be. On the venture side, I think that it depends entirely on the partner in terms of the practical value add, what that person brings to the table, how much time they are willing and able to spend with you, and the relevance of their experience. I think that Mark makes an excellent point. All things being equal, somebody who knows the market better, or collectively knows the market better, is probably going to be able to be more helpful. I do find, as a personal opinion or experience, that beyond a certain very elite tier of venture community, I don't know that reputation matters as much to me. And there are so many opinions on it. This is one of those topics where there is no right answer, or at least I don't believe there is one. But I would say beyond that early handful, I tend to think money's green. And it spends just as well from any source. That's obviously kind of a populist and oversimplistic statement. But it really comes back to who's the partner. If I'm with a great firm and a lousy partner, I'm not going to be happy. If I'm with an unknown firm but have a tremendous partner, somebody who's really got a lot of drive, a lot of passion, somebody who hasn't made their mark yet, and by God are going to make it with your firm, that partner is going to be tremendously valuable to me, and it could be from a firm that is not in that top 50 list. So I think there's not a simple answer. It's a question of doing your homework and diligence. It is easier to do that homework perhaps today, but if you don't do it, you're going to be potentially much more surprised than if you do.
So I'm always reflecting on this advice where you get a choice of investors as if that's something that happens to most entrepreneurs. There certainly was a day, and for some, if I do the quick math in the room, for one or two of you, you'll probably have a chance to go pick your investors from the top firms that you pitch. And I wish I knew which two of you it was. I think for the rest of you, you're going to get money anywhere you can get it. And I tried to back a guy. I remember he was literally living on friends' couches in New York, and he owed his widowed school teacher mother $60,000, who had been invested in his company. And I said, so you've got receipts, right? I mean, you've got a loan document with your mother, right? She lent you money because I'm going to pay some of your debts here just because I really wanted him to pay his mother back. He said, no, I don't. I said, no, what I'm asking you is to give me a copy of the loan note. He's like, but I don't. I was like, yes, I'm sure it's in a file somewhere.
Some people you can't.
Yeah, exactly. Along with your credit card receipts for the desks and the computers, because I think you've probably got a lot of $100,000 here. You should submit to me as invoices. So anyway, so obviously, investors come in different styles, and I think that the thing to keep in mind with the venture capital industry is it's a financial industry, right? It is populated by personalities who have passions for specific industries. And if you can be smart enough to pitch the guy or the gal that's got a passion for the ad space or the internet space, you certainly can save yourself a lot of time. That being said, we work inside partnerships where our partner's role is to grab us by the back of the collar if we go too deeply down a path that they don't think bears itself out. There's a check and balance mode. That's why there are partners. To one of Don's points, partners are as different as night and day in the same partnership. To say that you've got a partner at Kleiner or a partner at Excel or a partner at Palomar or Sequoia. I was just at a board meeting over Sequoia's office immediately before this panel. I was reflecting to myself as I was walking through on my way out how different these individuals are. We're all very unique. That being said, there are a couple of things to keep in mind when you're pitching a VC with the goal of having a couple of them competing to give you money. One is, someone said this to me the other day as if in shock, it's like you guys are all looking for a reason to pass. I was like, yes, I am. Why? Because I get more unfiltered deal flow across the transom than I can cope with. And in most funds, you've got associates in there screening, and all they're looking for is for you to come up with the reason why they can say, not for us, because they've got more than they can possibly fund. Most partners do 1 or 2 deals a year. For you to be the deal that I'm going to do, I've got to be drunk, stupid, in love with what you're doing and really want to do it emotionally, and then I'm going to look for all the logical number reasons to back me up so that I can defend you in my partnership. So the first one is they look for reasons to pass, and you want to focus on that. The other is, as financial vehicles, I always can sort of smell dead fish when someone comes at me, clearly having looked at my bio and tells me how much they value my sales and marketing background to help them out. Now, there are egos in this business where playing to them is going to help you. With me, all the antennae go up as to, tell me more about the business. Because frankly, from a scale perspective, VCs are looking for deals where they don't have to come in and do a tremendous amount of heavy lifting in your company. They want to be value add. There are some that really get off on really getting engaged in it. But as a financial institution, from a scale standpoint, I'd say that what they're looking for is the single best entrepreneur they can find who can carry their company without really needing a ton of work. They want to help you build your management team out by getting you referred to great recruiters or great contacts or people they know in other companies. But on a day in, day out, shoulder to the wheel basis, the comment in my partnership is you can always do sort of one project with a capital P at a time. That's 2 founders and a dog working out of their garage or their living room that you're going to help get all the way up to the next round. You can't shoulder from a fund standpoint. This is why incubators tend to come and go and fail. It's incredibly hard to shoulder the load of helping startups if you're doing that across 2, 3, or 4 deals at a time. And so, on one hand, I guess I want to tell you, pitch to somebody who you think can help you, but don't drill down too hard on how much you need their help or how much work they're going to start to build up in their mind that they're going to need to put into the company. Because remember that you're pitching a financial institution, right? It's a time and return on time kind of calculation that feeds the venture business. And as I said, with the risk of generalizing, with notable exception, there are people, in many cases senior partners who have come out of one particular space who just love to go deep with you. But if you're talking about the vast majority of VCs who are journeyman kind of practitioners of their craft, they're going to be watching that load balance issue. And that's why you talk about backing people first, because people understand their market's cold and they're like, this gal is going to have like complete ability to kind of go get this thing up and running. I can come in and add some value, do a couple of coffee meetings, come to board meetings, but I'm not going to have to shoulder a big load here. So watch out for that. Watch that balance, I guess, when you're pitching. And for those of you who are going to get a chance to have funds competing for you, pay attention to all those different aspects of who's going to be able to give you some help. But for those of you who are just trying to get money, remember that when you're pitching.
This is another point. One of the things we did in the early stage of the company is, we had something like a dozen investors. Rather than getting them to say, have you thought about this? Have you thought about that? We would send a quarterly email to them all saying, this is an update on the business, but can you help us on X, Y, and Z? So we would make it very clear that they're there to help us on these particular issues. And by the way, this is what's going on with the business and your money. So I think one of the mistakes we made early on was just to say, well, they're very busy, important people. They're far too busy to help us in our business, but if you ask them, one, they stop annoying you about the stuff that they think is particularly important to them, but it's not particularly important to the business. And two, it helps them in all sorts of ways which you didn't know, whether it's finding office space, which is kind of a very boring process, but very time-consuming, to hiring the next superstar executive.
Those are the emails you love to get. Do you know somebody at
Yes.
Sears? Do you know anybody who can help us find real estate? Do you know somebody? I mean, it's a straight point request,
Yeah.
and bang, you either can help them or not. Right. Definitely make use of that.
I don't know if I have much to add here other than, I guess in my experiences over the years, I would say that it's surprising how few executives ask for help at all levels. I bet you that more Fortune 500 CEOs ask for help and have coaches than middle-level management. And yet they're the stars, right? They're running the $20 billion companies. But everyone needs help. Even Roger Federer needs a coach. Everyone needs help. And I think as an entrepreneur, your natural inclination is I'm a doer, I don't need help, it shows weakness. Okay, I'm going to raise money from the venture capitalists, and what I'm going to do is, I don't want to show that I'm weak, so I don't want to ask too much help. And obviously you don't want to call them every day, because then you're high maintenance, right? But there's an extreme between that and saying, I don't really know what I'm doing in this area over here, but I'm not willing to ask for help. I'm not willing to admit to myself as I look in the mirror that yes, I can learn how to do it because I went to Stanford Business School, so I can learn anything, but someone probably has done this before me, and it's going to cost me time and capital and dilution to do it this way. You don't have to be good at everything. I can tell you, as an executive, when you have a job, when you have 1,000 people working for you, you don't do anymore. You just lead. And at best, you pray you're a good manager. They do the work for you. And if you don't get them the help that they need, you lose. Because you can't be there. Like 18 direct reports, 1,200 employees, too much is going on. But what I can tell you is that if you were to say, well, Mark, of all these 18 direct reports who work for you, which are the ones that you really cherish the working relationship? I cherish the operating relationship with the executive who comes to me and says, Mark, I need help in these areas. I'm like, thank you, you've made my job easy. You've told me where you need help. I don't have to guess. I don't have to mind read. I haven't been over to that division in 2 months. I wonder where they need help. You're calling me and telling me I need help. That's not weakness to me. That's strength. You're making my job easy. And if I'm a venture capitalist and I've invested in 18 deals and I'm on 11 boards, I don't have time to call you every day, even if I wanted to. So if you call me on a point basis and tell me where you need help, it's not even 6 degrees of separation. In the Valley, it's 1. I don't care if it's in sales, monetization, HR, marketing, branding, cost management, raising capital, insurance. It doesn't make a difference. 1 call and I'll get you the answer. I'll know someone, some executive, someone in my partnership group, my LP group, my friends of the fund to get you. And you know what? I feel better that you called me I feel better about myself that I added value. I was like, wow, I can justify what I did. I added value. I'm glad that- I'm serious. I mean, you know, it's not that I don't believe I can, but I'm doing a lot. I've got 11 deals and I've got 6 people presenting, and I've got my partnership meeting on Monday. So don't be afraid to ask for help within reason. It's really, really important.
That also prevents the Monday morning quarterbacking that Pete was talking about, which is you come into a board meeting and you're getting this pop quiz about what's going on over here, what's going on over there. You know, you get the questions up front. I need help in this, this, and this, and you sort of feel bought into the problem-solving process. You don't come in and launch flaming arrows into things that are not going right in the business because you got blindsided by them. The other point on that is, do not surprise anybody in a board meeting, right? If you've got a burning issue, you better make a few phone calls before someone comes in. If I come in and I flip out, you know, or 8 o'clock at night when I finally get the deck for the next morning's meeting, don't do that either. And I'm opening it up and I see news that I had no idea was coming, that's bad, right? So keeping that communication going, I think, is a really important issue with your angels that can help you, with your VCs that can help you, with anybody. You know, keep people informed and proactively ask for it, and they won't have as much momentum in giving you a hard time about something.
So if we can, just, I know we've only got 5-10 minutes left. 7 minutes left. So why don't we try to take a question or two before we let you interact with the panel one-on-one. Any questions?
So, Amanda, this might be for you. What is the reason for not going to, or what's your, you had mentioned earlier about not being able to go to business school or having done so, and you get that asked all the time.
Yeah.
I'm curious about your response on that.
Why didn't I go to business school?
Yeah.
Some of these people didn't go to business schools.
Oh, good. Yeah, okay, so I'm not the only one. I didn't go at the time because I had gotten into a sales career and I was making a fair amount of money. And I kind of sat back and said, well, let me show you, I'm going to forego this income level and I'm going to pay them that much, and then I'm going to come out, you know, so it was a matter of timing. I'd gotten married, I'd bought a house, I kind of had that big, I had all the issues that I now look for in salespeople, which is a really high expense level, and, you know, I like people whose spouses don't work and have 4 kids headed for college, if I can find them. A big house in Blackhawk or something. So yeah, so I was just at a point where I was, I frankly was making a lot of money, and I now, why do I wish I'd done it aside from having improved my golf game? I think that there was a, you know, at some point you get into business where you feel like you understand it. And maybe I didn't have to go to school to get most of the points, and I got MBAs that I could hire at some point. I regret it a little bit from the network perspective, because so many of my friends are, you know, how do they know so and such entrepreneur? Oh, they were in their class at the GSB or at Harvard or something like that. And I think that there's a lot of resume value for some people, but later on in your career, I'm 25 years out of undergrad, I mostly look back on it in terms of the network and the people that tend to hang together as a cohort as you go through your professional career. And that's usually what I tell people, especially in this most recent economy. These associates have been coming up to me saying, do I need to go? I'm like, oh my God, go. You know, like, go. Right? What are you going to miss in the next year? It's probably harder to get in now than it ever has been, but you know, I think it's a good experience. I'm not going to sit here in a room full of business school students and say, you know, you shouldn't have gone. I think it's a tremendous thing to do. Yeah, exactly. Know your audience. That's with all venture investments, know your audience. So it was a timing thing for me, not an intentional, I don't need that. In fact, I look back at every time I open an Excel spreadsheet, I'm like, God, I should have gone to business school.
One of you mentioned about doing due diligence on your investors. What are like the main questions that you ask or want to get answers for before you go with someone?
I think when I said that, will they support you? Will they be there? I mean, it's easy to back a company when things are going well. I would think Mark's advice is absolutely the best, no matter how well you do. Yeah, there's always difficult times. And you don't think of it. I mean, Google had difficulties. Google had a hard time getting the original seed dough. And the first couple of years, you had venture capitalists, famous venture capitalists, who were pretty doggone curious about how the hell they're going to make any money. And, you know, shared that intense curiosity with the guys running Google. And so I think you're looking at, will they be there? Yeah, for me, that's the first question. Second, by this point in my life, it's, are they an asshole? You know, are they just impossible? I mean, demanding's good. Demanding makes you better. Are they just an asshole I think everybody has their own interpretation of that word, and we should probably take it off the tape.
I was assuming you were saying, are they a hassle?
I like you. It's this accent. I was a hassle. Are they a hassler? But, you know,
I'm sitting there saying, is he saying that? No, he's saying, are they a hassle?
we don't know each other. But
We do now.
so, you know, for me, those are a couple of key criteria.
Yeah, but who says no when you say, are you going to be there for me? Just out of curiosity.
No, on the diligence front. She's talking about when you're talking to other people, have they stood up with other people? So I'm talking about you're reaching out to people that they've given you as references, and ideally you're reaching out to people that they don't know that you reach out to as references. But that's just one.
Trying to find a CEO
Which shouldn't be hard to do.
through tough
Yeah.
times
And
with that person.
I don't know any perfect investors. Everybody I know has had lots of bad deals.
I wouldn't even call the people to give as reference. I think for my first job, I listed, because I worked for my dad as an office boy, and so I had to say what my job experience was. So it's my dad's company, and they didn't figure it out, so they called the company for a reference, and they got my dad. And he said, I did a really good job. They never figured out that I was your father, and I told them the whole thing. That's probably how I got into Stanford Business School, right? So what is the point in calling someone that they give you as a reference? I can tell you what you're going to hear, great things. Call the companies that have failed. Call the companies that do not have a good relationship and say, when times are bad, did you divorce me? I mean, that's what you really want to know. When times are good, everyone can talk about great memories, but that doesn't help you. You're not trying to manage for the upside. You're trying to protect yourself on the downside.
Not even the companies that have failed, but the CEOs who have departed.
Yeah,
even
CEOs who are
successful
fired, CEOs who quote unquote quit. It doesn't make a difference. But
companies.
I would not
Went to
call
spend more time
them.
with their family.
Yeah, whatever.
With those partners.
Actually, I have a question for Pete. When you shop around for VCs back at the days when you're in business school, did you worry about like your idea being stolen by VCs and things like that? How did you protect
kind
your
of-
idea back then?
So just to repeat the question, so how much to share when fundraising? I think it's a difficult challenge. We were fairly, we weren't public, but in meetings we were very open to I wasn't worried about people stealing ideas because it's not in a VC's interest to get that sort of reputation. You hear rumors that this stuff happens, but VCs do not want to get the reputation for doing these, for stealing people's ideas and then funding over here. So I would just be upfront, be honest, be open. I wasn't a big concern.
But how much did you think about telling the VC about your whole business plan or something you actually had a home bag, or how much you want to expose the VCs? In terms of the whole idea, the whole execution plan, strategy, things like that.
I think actually a fair amount of detail. I mean, obviously you've got to share that detail if you're going to get money.
Yeah.
I mean, you don't go into huge detail in the first meeting.
But you don't expect to get money in the first couple of conversations, right?
No.
So.
So don't worry about it.
I think the rumor about VC stealing ideas and finding other management teams to pursue them came out a lot sort of in the bubble. And part of the problem was, you got 6 different people pitching you on the ideas of shipping bags of dog food FedEx, right? I mean, ideas come in waves, right? I still refer to the summer of security in 2003. There was the spring of Ning, where all we saw were white label social networks. I mean, in so many cases, you're not the only people to think of something. And so what happens is you get pitched on something, that team's not quite right, you get pitched on it by a great team, you do that deal, entrepreneur A thinks you stole their idea. So VCs don't sign NDAs. You also mentioned the concept of a business plan, and I suppose this is the wrong room to say, don't write me a 30-page business plan, because I'm sure there are classes on writing business plans. But, who we're backing is people and ideas and markets, and, a 5-page layout of what you're going to do. If you don't have any money yet at all, I don't know, a plan is an exercise in showing me that you know how to write a plan. That's about it.
I think the likelihood that your business dies from lack of funding is a significant order of magnitude higher than the fact that your business dies because somebody who hadn't thought of your idea takes it, pulls together a team, is able to finance it and get to market before you do. I think when you look at weighing off risks, the likelihood's probably pretty low. I think do we have time for one more, or are we done? Last question.
I get that venture capital seems to have a threshold where if your capitalization is not going to exceed that, then they're not going Mark, is there kind of a similar threshold for angel investing? And if so, do you still maintain the like absolutely not friends and family?
I don't think by definition angel investors are valuation sensitive per se. I don't think any of them have enough in the deal to really make a difference if they think about it. I mean, I know I'm oversimplifying, but they're investing in people. I mean, of the last 10 angel investments I've made, 6 of them were in convertible debts where it was unclear what the pre-money I was going to invest in. So let's be clear here. I invested money that's going to convert at a 25% discount to whatever pre-money they're going to raise money at. And if I help that company get a high pre-money valuation, I'm hurting myself when my money converts. I mean, it's a little bit ironic, but they do it, and then I'm helping them, and then some do it. So, you know, why did I invest in convertible? I like the individual. I like the idea. I've had industry experience with that person before. I bet on people. I mean, maybe that's maybe a wrong approach or a right approach, but it's for me. I mean, as an operating executive for your career, you bet on people. You have to. They work with you, for you. You're at their mercy for success. And so you look for certain ingredients, DNA, style characteristics, or otherwise perseverance, intelligence, interpersonal skills that you think, you know, this person's a winner. And I believe in that individual. And more often than not, the business plan is not going to end up being what I was shown. It will change between the convertible note version 1 and convertible note revised terms because they were oversubscribed before even preferred A came in. So I'm betting on people. So I think the first answer, which is, I don't think there's a floor value. Yeah, if you came to me and said, Mark, we're raising $2 million at 150 pre, and here's my business plan, I would laugh, but that doesn't happen out there. And I've seen angel rounds now, unfortunately, go into the double digits and higher. And, you know, it used to be 3 million, 5 million. How much is a business plan in a dog worth? How much is well, it depends upon the dog. How much is a business plan in retriever worth versus, you know, a pug? Okay, 4 or 6 million pre. Now I'm seeing plans like 18 million pre. No product, no prototype. Well, we want 22 million pre. It's incredible, but they keep coming. And the angel investors keep coming and they invest because they're investing in people. So that's the first thing. So I don't think there's a ceiling per se as to where you would invest in.
I saw a deal with $20 million in angel money not too long ago. Absolutely blew my mind. I'm like, I said, where's your financing? Angels. I was like, no, where the other financing? Angels. I was like, no, I mean the institutional money that came in there. No, it's all angels. I just stepped back in my chair like, you know. That's also a sign of the times in the venture business as well, though.
Yeah, I think there's a lot of coloration in the angel area just as there is in the venture. And it would depend a lot on who you're dealing with. I think for a number of the angels, it's not a terribly different experience, and they're probably not going to sign a note. You know, they are going to price the round, and then there are plenty, and probably the majority, that will do a note. It depends on the nature of their background and experience as well.
To Mark's point, VCs invest in people too. You ask any VC, any fund, brand, big brand, small brand, it's people, almost always, people first, then markets, then everything else.
And on the friends and family, I mean, as Mark pointed out, it takes an instant for friends and family to turn into enemies and in-laws. And there's a high cost of being wrong. So if things work out, and even, I mean, everybody here at the table, I guarantee you, has examples, even where deals went right, that things ruined relationships. Why didn't you let me have more? Why didn't you tell me it was time that I should have sold? Why wasn't I allowed to participate in the next round? So you're really kind of mixing two very separate relationships, one that's market-based and professional kind of terms-driven, and the other one that's very emotional. And I think you end up with you are injecting a tremendous amount of risk in your personal life. I mean, think about it as an entrepreneur, having been through this. Think about an entrepreneur when your business is going south. I mean, who do you want to turn to? Like, are you going to call all the people whose money you are now losing for your emotional support? I mean, it just makes Thanksgiving dinner a whole hell of a lot harder. You know, when you lost Aunt Millie's $75,000 she was planning on retiring on.
Because Mark, I mean, we talked about saying don't do friends and family because of the emotional risk associated with it. Mark has mentioned that it's dangerous to get high-profile angel names, you know, because they're known to the venture community, they're going to be references for you. So I guess if I'm sitting in the audience, I was like, So tell me again where I go to get angel funding, right? I mean, what's the
Low
middle
profile is
ground?
not your friend. I
Right.
mean,
Low profile is not your friend. And so we've wrapped it up. We're done.
like the neighbor in the corner, at the very end, you know.
Just
I will say one thing about the friends and family, though, that is important. More often than not, if you ask a friend, are you good for this, right? I mean, you're asking them, are you good for this money? Are you a sophisticated investor? Can you afford to lose this money? What are they going to say? Actually, I'm dead broke and I can't afford to lose it. They're going to say, I'm good for it, fine. And then the market crashes and you have a 35% NASDAQ pullback. And what seemed like a good investment because they had plenty of liquidity 2 years ago, suddenly they're freaking out at home. They're calling all capital in. And then now, you haven't heard from them for 5 months. They're regretting at the family table, I can't believe I invested in Mark's company. You know, when am I going to get liquid on that? I shouldn't have put that $50,000 in. You didn't do anything. You know, the NASDAQ crashed. So I just think, whereas Sequoia's not going to tell you that, that's what they do for a living. They're not going to regret that they put the money in before the market crashed. They're going to be happy.
And I think there's a pretty big differentiation between friends and family and angel investors. I think there's a distinct, you may have friends and family who do angel investing, but that's different. And I've lost, I mean, my college roommate doesn't talk to me anymore because I invested in his company, it went south and he lost my money. And he won't return my call. I'm totally happy with it. But he's embarrassed and doesn't want to see me at reunion, so we don't talk. I mean, there's just so many risks associated with it.
Now we're talking about the relationships between people and money.
The
Yeah.
times
Take
I've
that
seen
personal
founders
money.
cry is when something's coming down in a venture financing round and they've got to go back to their friends who are in the angel round, and it's literally grown men to tears. I've seen it on numerous occasions, and it's just, and you're supporting the company. I mean, you're putting money in to move the company forward.
You done about the recap?
Yeah,
That
I
would
mean,
cram down.
but the result, even just follow-on rounds, I mean, angels just get washed and washed and washed unless they follow on. It's just visualize that conversation and see if you're ready to have it, because that happens to a lot of companies.
So we're out of time. Please join me in thanking our tremendous
Last conversation about Thanksgiving dinner in this room today. We've got some snacks outside in case you're still hungry. We're coming back at 2.